France is currently facing a political and financial crisis. High debt, rising interest rates, and an unstable government in an increasingly polarized society. In this video, we show you why political instability costs real money and explain in a simple and understandable way, using France as an example, what is meant by the term interest rate spreads. In France, the debt ratio has increased from around 60% at the introduction of the euro in 1999 to 113% of GDP by the end of 2024, as the graphic shows. This is the sharpest increase among Eurozone countries in the last 25 years. France has been violating the EU debt rules anchored in the Maastricht Treaty for years, which stipulate a maximum debt ratio of 60% of GDP. The budget deficit in France is estimated to be 5.4% of gross domestic product in 2025. Instead of saving, politicians in Paris are discussing how to reverse pension reforms and spend even more money. The result? A persistent upward trend in debt. And the financial markets, as well as rating agencies, are observing this very closely. When investors lose confidence, they demand higher interest rates. The interest rate difference between two bonds is called the yield premium, or interest spread. The German government bond is considered safe. Investors who buy 10-year German government bonds currently receive 2.7% interest per year. France must offer 3.6% for the same maturity. The difference between the yields of 10-year French government bonds and 10-year German government bonds is 0.85 percentage points, or 85 basis points. That is the interest spread. In addition to the steadily growing debt piles, political instability in France is another reason for the increase in interest spreads. In just 21 months, France has experienced 4 prime ministers: Gabriel Attal, Michel Barnier, François Bayrou, and finally, Sébastien Lecornu. The political upheaval in France was fueled by the French president after the European elections. Macron unexpectedly dissolved the French parliament in June 2024. Macron later described the dissolution of parliament as a mistake. The new elections did not strengthen the centrist bourgeoisie, but rather the extreme fringes in parliament. The centrist forces no longer hold a majority in parliament. The French National Assembly has fragmented into many parties following the unexpectedly scheduled new elections. For investors, this means increased political instability, more risk, and consequently higher risk premiums. The trend is clear. The interest rate spreads are rising and rising, in light of the steadily growing debt burdens and the political instability in France. An important influence on the level of interest rate spreads is the ratings of the rating agencies. You can think of ratings as school grades, with which rating agencies assess the creditworthiness of countries and companies. Agencies like Fitch, S&P, and Moody's evaluate how likely it is that a country will repay its debts. In September 2025, Fitch downgraded France to A+, while Germany remains unchanged with the top grade of AAA. It is foreseeable that S&P and Moody's will also downgrade their ratings for France. Any further downgrade would increase refinancing costs. Additionally, conclusion. France's national debt has increased from about 900 billion euros at the end of 1999 to over 3,400 billion euros today, according to Eurostat. An immediate collapse of France is not expected. However, it is heading into a crisis if it does not revise its unsustainable fiscal policy in a timely manner. The interest burden has noticeably increased, making public finances more vulnerable. Investors are only lending the country capital if they receive an additional interest premium to compensate for the higher default risk and political instability in France. The current risk premium is around 85 basis points. Is this justified, or are the markets underestimating the situation in France? Share your opinion in the comments. If you liked this video, subscribe to the channel, like the video, and stay tuned for more analyses of financial markets as well as economics and finance.